Understanding financial statements is one of the most useful skills in business because these reports show how a company is performing and where it stands financially. Whether you run a small business, manage a team, invest in companies, or simply want to improve your financial knowledge, learning how to read these statements can help you make better decisions. Financial statements turn daily business activity into clear numbers that explain profit, resources, debt, and cash movement. The three main financial statements are the income statement, the balance sheet, and the cash flow statement. Each report serves a different purpose, and when reviewed together, they give a clearer picture of the overall health of a business. Instead of relying on guesswork, owners and managers can use these reports to understand what is working, what needs attention, and what steps to take next. Let's begin with the income statement. The income statement shows how much money a business earned and how much it spent during a specific period of time. This could be monthly, quarterly, or yearly. It starts with revenue, which is the money generated from selling products or providing services. Revenue is often called the top line because it appears at the top of the report. After revenue, the business subtracts its expenses. These may include rent, employee wages, utilities, advertising, insurance, office supplies, and other operating costs. Once all expenses are deducted, the final result is either a net profit or a net loss. If revenue is higher than expenses, the business made a profit. If expenses are higher than revenue, the business operated at a loss. The income statement is useful because it helps measure profitability. It answers an important question. Is the business earning enough money to cover costs and create income? If profits are increasing over time, that can be a sign of growth and strong operations. If profits are shrinking or losses continue, it may signal rising costs, weak sales, or poor pricing decisions. Next is the balance sheet. While the income statement covers a period of time, the balance sheet shows the financial position of a business at a specific moment. Think of it as a snapshot of what the company owns and owes on a certain date. The balance sheet is built around three key parts: assets, liabilities, and owner's equity. Assets are items the business owns that have value. These may include cash, inventory, equipment, furniture, vehicles, property, and money customers still owe to the business. Liabilities are obligations the business must pay. These include loans, unpaid supplier bills, taxes due, and other debts. Owner's equity is the remaining value after liabilities are subtracted from assets. It represents the owner's share in the business. If a company has more assets than liabilities, equity is positive. If liabilities grow too high, equity can shrink. The balance sheet is valuable because it shows financial stability. It helps answer questions such as, does the company have enough resources to operate? Can it pay its debts? Is it building value over time? A strong balance sheet often means the business is managing resources well and keeping debt under control. Now, let's look at the cash flow statement. This report focuses on the movement of cash in and out of the business. Many people assume profit and cash are the same, but they are not. A company can report profit on paper and still struggle if cash is not available when bills need to be paid. The cash flow statement is divided into three areas. The first is operating activities. This includes cash earned and spent through normal business operations, such as customer payments, payroll, rent, and utilities. Strong positive cash flow from operations is usually a good sign because it means the core business is generating money. The second area is investing activities. This includes cash used to buy or cash received from selling long-term assets such as equipment, vehicles, or property. Businesses often spend money here to grow or improve operations. The third area is financing activities. This includes money received from loans, money used to repay debt, owner investments, or withdrawals. These transactions show how the company funds itself and manages borrowed money. The cash flow statement is important because it shows liquidity. In simple terms, it shows whether the business has enough cash available to handle daily needs. Even profitable businesses can fail if they run out of cash, so this report is often one of the most practical tools for decision-making. So, how do you quickly evaluate the financial health of a business? Start with profitability. Look at the income statement and see whether the business is making consistent profits. Growing profits often suggest healthy operations, while repeated losses may need attention. Next, review debt levels using the balance sheet. Compare liabilities to assets. If debts are reasonable and assets are strong, the company may be in a stable position. If liabilities are too high compared to what the business owns, that can create pressure. Then examine the cash flow statement. Confirm that enough cash is coming in to cover expenses, payroll, debt payments, and daily operations. Positive cash flow gives a business flexibility and room to grow. When profits are strong, debt is controlled, and cash flow is positive, a business is usually in a healthier position. When one or more of these areas are weak, it may signal risk or the need for changes. Financial statements may look intimidating at first, but once you understand the purpose of each report, they become much easier to read. The income statement shows profit. The balance sheet shows position. The cash flow statement shows movement of cash. Together, these three reports help business owners, managers, and investors make informed choices based on facts instead of assumptions. The more often you review financial statements, the more confident you become in understanding numbers. And once you can read your numbers clearly, you are in a much better position to improve results, solve problems early, and plan for future growth. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides. See you in the next video.